Good morning and happy Friday, folks. This is Alan Burdetsky with Boutique Realty and Reliable Home Loans here. Wanted to go over a little bit of how tax reform can affect you as a homeowners. First off, I'm not an attorney, I'm not a CPA, so full disclosure, any of this information is not tax advice. Please consult with your CPA or tax representative. I'm just here to give you a synopsis of how it could work. There's no real conclusion yet on how this is going to pan out. Right now, we have a plan in the House that's been proposed and a plan in the Senate that's been proposed that are slightly different. And what I did is I put together a little bit of a diagram to kind of give you an idea of how the tax reform may fall out. So in our first example, we have Kim C., who's a single teacher. She makes $50,000 a year in salary. She does not own a home. Currently, she's paying about $5,474 in federal tax, which puts her in a 25% tax bracket. According to the House tax reform plan, her taxes would go down $914, and according to the Senate plan, her taxes would go down $1,104. That puts her into a 12% flat tax bracket, and in essence, she went from 25% to 12%. Thus lowering her taxes. Pretty straightforward, simple scenario for a single tax filer. Our next example is for the Smith family. Let's just assume for this example that the Smith family comprises a husband who's a sales rep, wife is a part-time nurse, maybe she had some children, or they had some children and she decided to not work as much. So she's working part-time, he's working full-time. They have a combined income of $75,000 a year salary. They do own a home, and they have 3 children. Currently, the way it stands now, their tax liability would be $1,753 or 15% tax bracket. According to the House plan, they would be getting a refund of an additional $1,033, and according to the Senate plan, they would be paying $2,014 less in taxes, and that actually includes a $261 refundable credit that they'll get back due to some offsetting of a child tax credit. That, in essence, puts them at a 12% tax bracket. Just a couple notes here. The marginal tax would decline from 15 to 12% under both House and Senate plans. Their current child tax credits of $1,000 each would increase to $1,600 each. And under the Senate plan, it's supposed to go up to $2,000 each. So that's just some stuff to look out for. In terms of if you're a part-time nurse or a full-time sales rep, job doesn't really matter, just more along the lines of your salaried employees, you don't own homes. So the next example that we have is the Jones family. I'm sure there's a lot of families here in California that fall under this under these parameters. So let's assume that the husband and wife are married. Husband works for a startup. Startups, just like a lot of other, maybe even self-employed businesses, have fluctuating income. Well, let's just say he hit it big this year. He got a good stock option payout of some sorts. And the wife is a CPA. Let's say she makes about $100,000 to $125,000. The remainder of it was made by the husband. They do own a home. They do have kids. Under the existing tax legislation, this family would be paying $439,275 in federal taxes. That puts them at a 42.5% tax bracket. Under the House plan, they would be paying more taxes than they are now. They would pay an additional $87,993 in taxes. Under the Senate plan, they'd be paying $1,313 less in taxes. Under the House plan, they'd be at a 48.5% tax bracket. Under the Senate plan, they'd be under a 41.4% tax bracket. And this is mainly due to basically your rich tax. I got to read these off because there's so many adjustments. Under the current tax, Peter and Paige are facing a top marginal tax rate of, Mr. and Mrs. Jones are facing a top marginal tax rate of 42.5% taxes. Their taxes would rise 39.6% base tax rate plus a 6% bubble tax, and then the 2.9% Obamacare tax. All of that combined equals 48.5%. Under the Senate plan, it would fall to 41.4%, and that broken down is 38.5% plus 2.5%, 2.9% for Obamacare tax. So yeah, these guys are going to get hammered under the House plan, under the Senate plan, not that much of a difference. It's pretty much going to remain the same. Now, under the Doe family, this is what a lot of my friends and family fall under. Let's say that they're married. Sorry guys, gotta excuse the fire truck that's passing by right now. All right. Under the Doe family, this is a small business owner. Let's just say he owns like a blinds installation company. The wife helps out with the family business. She's not always at work, but maybe she does some accounting and whatnot part-time. Their combined income is $250,000 a year. Oh, there's the fire truck again, sorry. My apologies. God bless the Los Angeles Fire Department. Getting back to our example here, $250,000 in yearly income. They own a home, they have 2 kids, and at the present moment they would be paying $35,585 in federal taxes under the alternative minimum tax plan, which was created in 1982 to make sure that people that are self-employed pay their fair share. Boils down to a 35% tax bracket. Under the House plan, they would be paying $799 more tax, putting them under the 30% bracket, and there's some reasons why. I'll go over that in a second. And then under the Senate plan, they'd be paying $9,325 less, or a 19.8% plan, a 19.8% tax bracket under that. So under the tax plan, the Doe family would face a good deal more complexity. As a small business, they would face the top rate of 25%, but only 30% of that income would be taxed. The other 70% counted as wages would be taxed at the regular income rates, which range from anywhere between 12 and 46.5%, depending on what it is that they're reporting as income. At their current level, the top rate would also be 25%. However, on top of that, the Doe family would face an additional 5% tax due to the phase-out of their child's tax credits. Also, the Doe family makes $250,000 a year. If they report one more dollar than that, then they would be subject to the 2.9% Obamacare tax under both the House and the Senate tax proposals. So, net, you can see most people are going to save money, except for maybe this one right here and this one right here. So if the Senate gets their way, you're pretty much looking at a tax cut across the board. If you have any questions, of course, the mortgage deductibility. So the big question that I've been getting asked is, what's going to happen to my mortgage deduction? Very important to go over this. Under the House plan, they want to cap it at $500,000. Under the Senate plan, they want to increase it to $1 million, but they don't want to allow for secondary home interest deductions, and they also only want to allow you to deduct the interest on your purchase money loan, which means if you refinanced, then you would no longer be eligible for that deduction. With that being said, we are going to be at the Motor for Toys event this Sunday, December 3rd. Please bring an unwrapped toy. It's going to be held at the Anthem building in Woodland Hills Warner Center. We'll be there, the Boutique Mobile will be there, and we look forward to having you there. Please, again, bring an unwrapped toy. Lots of children that are in need of toys. And if you have any questions, please feel free to either call me at 818-312-0831. Once again, 818-312-0831. Or you can shoot a private message to me or leave your comments or questions in the comment section below, and I'll be more than happy to answer them. This is Alan Burdetsky. Sorry for the long Facebook Live moment, but I wanted to make sure that you guys understood this tax stuff. It is complicated. If you have any questions, call me. I'll be more than happy to break it down for you. Have a wonderful weekend. We'll see you soon. All the best. Bye-bye.